Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
One of the reasons it's also interesting is if you remember that the Asian financial crisis in 1997, 1998, that triggered a real change in the mindset of the Asian countries. They were very exposed at that point with U.S. dollar loans and things, so they said, next time we're going to build up massive FX reserves, and it's going to cover us during this storm. It just so happens, if you, again, go look at housing prices in the U.S. in 1998, and that's when they started taking off, just about the time when the Asian countries started building these surpluses and refunneling this money back into the U.S. market. They refunneled it back in the U.S. market, and it went into all these different derivatives and investment products that were created by the investment banks, which are no longer with us. So their refunneling of massive reserves, instead of investing in their own economies, was part and parcel to leading to this massive overconsumption in the West. Before 1998, the savings rates were in decent shape in the U.S., but when credit became basically free because of this recycling of these surpluses, the game changed. Now the game is changing back in a very, very big way and very, very fast, and we are finally getting, we think, the rebalancing of the global economy that the economists told us was really going to be good for everybody. Well, it's not very good for the Asian countries, I can tell you, because it's going to be a massive wrenching transition if their export models fall off the table. And one of the reasons you're seeing the countries in the West, the U.S., for example, pumping out so much money to try and create demand, they're trying to create demand to prop up the Asian countries. There's a lot of vested interest and a lot of big money and multinationals invested in places like China, so they want to keep them solvent. They know if they don't continue to pump up global demand through stimulus, even though it's not working, then these vested interests and these investments in China could really go down a black hole. So as a part of a political process here. One of the things we've always said is that you need to let private sector leverage continue to write off, and you need to only put a modicum of public sector debt in the system. You need to deleverage the global economy. And it's going to be a long, painful process. Unfortunately, our governments are trying to maintain the status quo, and it's just not going to happen because the U.S. consumer attitude has changed in a very big way. We refer to this chart right here as the unhappy convergence. We know that a lot of people continue to be optimistic on China. We understand that our view can be very, very wrong, but when it comes to China, we probably believe about nothing that they say. I've been to China, and it's another reason. The Chinese leadership, again, not the Chinese people, I make this clear, the Chinese communists that dominate the country really still have those people suppressed, especially the ones that aren't politically connected in the cities that get all the deals and are very, very happy and tend to show up on our financial press, but the rest are still in a prison camp, basically, as far as we're concerned. That's not to say we haven't seen a massive improvement in the quality of life for many, many millions of Chinese, but they're not unleashing them, because of their concern of social stability. And that's one of the reasons they haven't made as big an effort to build up their domestic market. So this guy, the president of China, is very, very worried. Unemployment is soaring in China in a very big way. We know the incidents, which is what they refer to them, which are riots, have been surging. There's dissent brewing with this thing called Charter 08. There's a lot of dissent, a lot of very brave people inside China that are stepping up, against the leadership, and of course being imprisoned right away. And there's a lot of people outside of China that are showing some real disgust for what's going on. And this is what we consider the social unrest thermometer. On the top here is GDP, Chinese GDP, and this is an old chart from The Economist. This is probably about 2 months old, so we've added a little bit to this. At the time, officially, the official Chinese GDP was supposed to grow around 8% a year, and the urban unemployment was supposed to be around 4%. Well, we thought that at the time urban unemployment was about 10%, and GDP was close to 5%. We've just come out and learned that they've at least ratcheted it down to 6% on GDP, but we think we've crossed over here in a very, very big way. And this creates a lot of social tension and unrest in China. But again, the outlet really isn't there for the consumers, and Chinese, really has control here. But there's some pressure cooking in here, and the reason this is important is because if China takes the wrong path here and tries to increase its export component as opposed to stimulating its consumer market in a very, very big way, we think this pressure is going to get, this social pressure will continue to build, and China could surprise very, very badly on the downside and cause another massive wave of risk aversion across the globe, which we tend to think would be very, very beneficial for the U.S. dollar. Now, if China stimulus works, if everything is hunky-dory, if the export model continues along its merry way, then China's in fine shape. The U.S. dollar will probably be pushed out again in terms of its dollar-based credit funding the globe, and the dollar will fall in value, but we're not sure if that's going to happen. In fact, we don't think it will. China's stimulus so far in the first quarter, they spent about $580 billion in stimulus. They spent, they allowed the credit system to open up. There was about $738 billion in credit through new lending in the first quarter. So that's $1.2 trillion of lending that we've seen out of basically of money coming into the economy in China in the first quarter of the year. And that's a good thing. But the bad thing is most of this money, and we wrote about this morning in our letter to our clients, is most of that money has gone for infrastructure projects, and a lot of the money has gone to prop up the stock market. The two reasons that is because the people, the elites in China, benefit mightily from those two areas. The other part of the spending has gone to try and increase export components. So already they're facing massive overproduction and massive saturation, but they're using this money to build more infrastructure and try and push out more exports instead of building up the consumer market, and I'll explain why that's important in the next slide. So the point is they have front-loaded this massive amount of stimulus, and to us it hasn't gone in the right area in terms of funding, in terms of trying to build up the consumer and their domestic demand. We just don't think the global demand is going to rebound, and if it doesn't, the money spent for infrastructure and building exports is basically a bridge to nowhere. It's going to create some jobs, but you got to stimulate the consumer in a very big way, and I'll get some more of that in detail when I show you on this slide why we think China right now is exactly where the U.S. was in 1929, and we think they may make a big mistake. Again, if you remember some history about the U.S., back in the 1920s, the U.S. was the world's major exporter. We were the major overproducer. We had massive overproduction in the U.S. We were sending stuff out to everybody around the world. We had a massive current account surplus. We had a lot of productivity coming into our manufacturing sector from people coming in from the rural areas into the cities, very much like China is doing. Obviously, there's some key differences. And then we had a little problem, and very much similar credit problem of with the Fed playing some games on the money side. Needless to say, the credit system started to tighten up, and people around the world started buying less and less of U.S. goods. Well, the U.S. made the mistake. Instead of turning its stimulus in domestically to try and build up its consumer market, at the time in the 1920s, the production side, the manufacturing side of the U.S. was much larger than the consumer side. So the key to alleviating the pressure of this growing recession that's turned into a major depression was to stimulate the U.S. consumer. Instead, the U.S. decided that they needed to push this adjustment that was coming off onto its trading partners, and we had the Smoot-Hawley major trade tariff, and we cut the imports from other countries, but continued to try and force them to accept our exports. Well, they decided they didn't want to accept our exports, and they put up their own trade barriers, and we have the major global depression, which we know in the 29 and the 30s.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.